Health savings account distributions are a critical area tested on the exam, primarily focusing on the distinction between qualified and non-qualified uses of the funds. A qualified distribution from an HSA is one made to pay for qualified medical expenses for yourself, your spouse, or your dependents. These distributions are completely tax-free and penalty-free, which is the main benefit of an HSA. The exam will test your knowledge of what constitutes a qualified medical expense. Think of things like doctor visits, dental work, prescriptions, and eyeglasses. It generally does not include things like elective cosmetic surgery or over-the-counter medicines, unless prescribed by a doctor. The real exam traps appear with non-qualified distributions. If a taxpayer takes money out of their HSA for a non-medical reason, like buying a car or going on vacation, that distribution is fully taxable as ordinary income. More importantly, it is also subject to a 20% additional tax or penalty. This 20% figure is a key number to memorize. The exam will often present a scenario to see if you applied as correctly. For example, a 40-year-old taxpayer takes a $5,000 distribution from their HSA to pay off a credit card. The tax consequence is that the full $5,000 is added to their gross income for the year, and they will owe an additional $1,000 penalty, which is 20% of the distribution. However, the exam loves to test the exceptions to this 20% penalty. The penalty is waived in 3 specific situations, even if the distribution is for a non-qualified expense. These exceptions are if the distribution is made after the account holder turns age 65, becomes disabled, or dies. It is critical to remember that while the 20% penalty is waived in these cases, the distribution amount is still included in the taxpayer's gross income. So, if a 67-year-old takes that same $5,000 for a vacation, it is taxable income, but the $1,000 penalty does not apply. This is a common point of confusion. The exam might present 2 identical scenarios, with the only difference being the taxpayer's age, one below 65 and one above, to test if you know how to treat both the tax and the penalty. Reporting for HSA distributions happens on Form 8889. The total distributions from Form 1099-SA are reported, and the taxpayer must then calculate and report the portion used for qualified medical expenses. The difference is the taxable amount. The IRS puts the burden of proof on the taxpayer, so meticulous record-keeping is essential. A common exam trick might involve a taxpayer who has distributions but lacks receipts, implying the distributions would be treated as non-qualified. It is a simple way to keep the penalty straight. Just think, HSA hurts at 20%. This helps distinguish it from the 10% penalty associated with early withdrawals from other retirement accounts like IRAs and 401ks. The exam writers know that students confuse these 2 penalty rates, so they will almost certainly include 10% as a distractor answer choice on a question about non-qualified HSA distributions. Remember, for HSAs, the penalty for non-qualified use before age 65 is a harsh 20%. Always double-check the taxpayer's age and the reason for the distribution in any exam scenario. This careful analysis will allow you to correctly determine if the distribution is tax-free, taxable with a penalty, or taxable without a penalty.